again, thank you all for signing on today. This is becoming the new normal. We've been using a lot of technology to still be productive in today's environment. So it's been a little bit of a learning curve. Fortunately, we've put some, a lot of these things into place already due to more natural disasters like hurricanes. But it has been very applicable in today's environment as well. So, anywho, so the topic of today's webinar is a bit of a continuation of what we did last year. We did last year was a ladies only event. We did an Investment 101 seminar, back to basics style. And this is a bit of a continuation off of that today. Obviously, the emphasis being market volatility, which is a very timely topic considering the current environment. So the idea is to try to do it more from a learning perspective. So a lot of definitions and how we use different terminology. A lot here in the office we throw these terms around all the time. A lot of times it goes over people's heads. So the point of having these webinars is to kind of help our clients understand. As for any clients at Pathfinder, that's one of our primary goals is to educate clients through what we do. And not just telling folks what they should be doing, but educating and allowing people to make their own decisions based on an educated thought process. All right, so the agenda for the call today is really threefold. So as I mentioned, the goal is to motivate, educate, and we break this up into three different sections. So first, we're going to talk about what is market volatility. Then we'll go into where we are now with the current state of volatility in the markets today, as we know, which is rampant. And then lastly, how does this apply to your own situation? So that's a big one. I think it's important to note at this point that for a large portion of when we talk about market volatility, we think of stocks and the stock market. So a good portion of this content here is tied, talking about stocks and the stock market and volatility in stocks. For most of or a large portion of our clients, we also have money in bond investments, which have lower volatility and risk relative to stocks. But it's important to state that there is volatility in bonds as well, just not to the level of stocks. And as with stocks, as with bonds, similar to stocks, not all bond is created equal. So there's a risk spectrum with bonds as well as there's a risk spectrum with stocks and other assets such as gold and currencies, even cryptocurrencies have been volatile through this period. But for the purpose of today's call, we'll be talking a lot about the volatility in the stock market. All right, so first we're going to jump into what is market volatility. So starting with, let's talk about the definition of volatility. So this is the Oxford definition, so more from a common standpoint of what it is. The first two definitions here: the liability to change rapidly and unpredictably, especially for the worst. So that one, that context relates to the stock market for sure. In volatility, when most people think of volatility, they think of risk or downside there with especially for the worst. So volatility can be upside volatility too, but for the most part, when we think of volatility, we think of the negative or the downside with that definition. So number two is also not as relative to the stocks that we'll talk about today, but liability to display rapid changes of emotion. Now that's volatility from a personal side, which sometimes the stock market volatility can cause that. So that was interesting to have in there. Number 3, obviously unrelated to the stock market, more of a for any of our science or I guess chemistry folks like my wife, they would probably understand that version of the definition. So next jumping into the Investopedia definition of volatility. So this is more of what we'll talk about today, the more technical definition of volatility, a statistical measure of dispersion of returns for a given security or market index. So that's important. We could use volatility metrics for individual securities, whether it be an individual stock or a mutual fund, but also for a market index. So I'm going to talk a lot about the S&P 500 stock index today, the 500 largest companies in the U.S. That's the main benchmark that investors and market folks use. Dow Jones, Nasdaq are very well referenced as well, and very important to track those two. I'm going to talk about the S&P 500 stock index a lot today, just to keep it consistent. In most cases, the higher the volatility, the riskier the security. So, when we look on the risk spectrum of stocks, as I mentioned earlier, not all stock is created equal. Some may have higher volatility, so higher ups and downs in the price fluctuations. A small emerging company compared to a large, more established, mature company. That smaller company, you're gonna have the potential to have more volatility. And the way that we measure volatility, there's a couple of different ways, which we'll talk about today as well. Standard deviation is probably the most common measure of volatility in an investment. So we'll talk about that one, and variance between returns of the security or market index is another way to kind of track or measure volatility. So what causes market volatility? So if I had to summarize it in one word, I would say uncertainty. So we're seeing that today in the markets. We've seen that for the last 2 months in the markets, and uncertainty is one of the things that the stock market hates the most. So when the market doesn't have data to go off of, it works off of uncertainty, speculation, fear, and that's just that's what we're seeing right now. There's no one knows when the end of this pandemic will be. So the market right now is desperately trying to get on one side or the other of whether the data, once it comes out, and we're starting to see some of that now, is it going to be worse than what's priced into the market now, or is it going to be better than what's priced into the market now? So that's what's causing a lot of the volatility right now, the uncertainty of what this impact is going to be on company earnings, on the GDP, the main measure of growth in the United States, which is GDP. A lot of uncertainty of what that's going to do, and of course the fear as well can get in on the volatility is magnified by the fear that's out there. So when there's panic or fear rampant, the market's going to have these big swings. As we've seen right now, there's a lot of traders out there that are I guess essentially taking advantage of these swings as well. So that we're seeing a lot of that out there too. A lot of institutional traders are out there, and that's likely attributed to some of the swings in the market. For long-term investors, volatility is really, or the uncertainty, speculation, fear of a portion of it is largely irrelevant for a long-term investor, because we're looking at a long-term goal. Everyone, if you're invested in, for folks that are invested in stocks, it's important to have a long-term perspective on it. So going into how we measure volatility, so the standard deviation, as I mentioned before, is really the primary measure. And you know, if you ever took a statistics class, or even a finance class, they'll probably talk about standard deviation. And you know, it's with the little image I have there on the slide, there's that the bell curve, which we've probably heard references to a bell curve distribution before. So in the context of investments, the standard deviation is a measure of how much a price. So if we think about individual stock, let's say Apple, if we think about how likely Apple is to the price of Apple to go above the current price or below the current price, and how much that's going to fluctuate over a certain time period, that's what we're measuring standard deviation. So when we're looking at it for the purposes of trying to find good investments or trying to find investment opportunities, we'll go back and run maybe a 3-year or 5-year standard deviation, and that's going to tell us how much did this investment fluctuate either on the upside or the downside over that time period. So of course, every disclosure in our industry says past performance is no guarantee of future results. So that's not going to tell us the future, but if we can learn from the past of how some of these, how the investment that we're looking at has performed relative to the historical norms, which there is definitely something to take away from looking at that data. It's also important to compare apples to apples when you're looking at standard deviation. So when if we're looking at a particular investment, we're going to compare the standard deviation of that investment to a peer group or a benchmark that is similar in nature. So, going back to my earlier example of a small company stock versus a large company stock, the standard deviation is going to be higher on a small company stock because it's more volatile. It can carry more risk than a large company that's going to be less volatile. Or more likely to be so. So to give you an example, kind of going back to some of the indices in the markets. So the S&P 500, which I mentioned earlier, the Standard & Poor's 500, largest companies in the U.S., it has a standard deviation of 15, just over 15. So that means the price can, or the value of the index can, fluctuate by 15% on the upside of the downside over a given time period. If we compare that to the bond index, so the Barclays Aggregate Bond Index is a benchmark for bond investments. It's 3.2, so a lot lower volatility than the S&P 500 stock index, and purposefully so. That's why we have bonds in many clients' accounts to act as a measure of stability. In comparison with the S&P 500 index, if we look at the Russell 2000, which is 2,000 small companies in the U.S., it's got a standard deviation of 21. So that gives you the comparison of small companies, would have the average standard deviation of 21 versus the S&P 500 index to be around 15. So important, not necessarily important for you to remember. This is something that we look at on the back end when we're looking at different investments. So it is widely used in our industry. And as I mentioned before, the higher that number, the more risk of the particular investment. So another way to measure volatility is something called the volatility index, or the VIX, is what we commonly call it here. So the Chicago Board of Options Exchange it created this index, and it's a way to measure the volatility in the market, or really the expectation of volatility in the market. Also known as the fear gauge or the fear index. So we track the VIX index to we compare that to historical data. We use it as really just kind of a way to see, how bad the volatility is expected to be, and relatively we can see how the stock market is moving relative to the VIX. It's not correlated. So when the volatility index or the VIX peaks, that doesn't necessarily mean that the market is hitting a bottom. But it does give us a point of reference to see, is the volatility calming down? And I'll talk through a couple of examples. You can, by the way, buy the VIX index. So there's some ETFs out there that will allow you to buy the VIX or short the VIX. So there's a lot of traders out there that use that as more of a speculative investment, and say if the VIX is below a historical norm, let's buy it with the expectation that volatility is going to come back someday and profit from that. If you're seeing the chart in front of you now, I've got the next a few slides, I guess, are charts, and I'll walk through these as I go. Again, doing it, through a webinar, it's a little more difficult, but to not bore you to death, I don't have a whole lot of charts in here. But what this does is, now what I've got in front of you now is a 15-year chart of the VIX index. So this goes all the way back to 2005. So you can see the first peak there, right during the 2008-2009 Great Recession. So you can see from this chart, it peaks at 60. I will note that this is a monthly interval, so it takes the value of the VIX at the end of every month. So it does miss any intra-month peaks or troughs in the VIX index. And I'll talk a little bit about that on the next slide. But to give you an idea, you can see there, and this is interesting. I'll point out a very interesting fact that relative to the Great Recession and what's going on now. So right here, this shows that the VIX peaked at around 60 on a month-to-month basis back in 2008, 2009, and it's about 54 or so in today's environment. So obviously, you can see there where we've seen volatility as on a scale comparable to what we saw in 2008, 2009. The purple line, if you see that across there, that's the 15-year average, which is 19. So that's a pretty low average, despite these big peaks. That over the past 10 years, the VIX has been at very low levels. And so that that's interesting. What we typically the kind of rule of thumb is anything above 30 is a extraordinarily volatile period. So once we get above 30, we're still above that range. We're 41 as of yesterday. So still in a volatile environment in the stock market, and we're seeing that day to day. So if we let me make sure I didn't skip one yet. Okay, so going to the next slide here. So this is the recent VIX. So this is the volatility index again over the past several months. So going back towards the end of January, and this is a day-by-day interval. So before, if we just use month by month and looked at the month-ending value, it showed a peak of about 54, and now it's up there above 80. So the VIX did peak at 82.69. So it went above 80 just briefly on March 16th. And to give you some reference here, back in mid-January, it was all the way at 12. So it went from 12, shot up all the way to 82 just within a couple months, which is unprecedented. Another interesting factoid is that if we compare that to the Great Recession, now if we look back at this chart in front of you through the Great Recession, this is just a snapshot from September 2008 to January 2009. You can see it does get above 80, and in that instance, it actually peaked twice. Just barely got above 80 back in it looks like towards the end, right at the end of October 2008, and then it peaked again in November, towards the end of November. The volatility index, the VIX, has actually gotten higher in this current market environment than it was at the peak in 2008, 2009. So that's pretty interesting that we've seen more volatility, which, we have seen some, unprecedented up and down days in the markets, which is the reason for that. We'll talk about why that might be in just a second. One thing that's interesting, what I mentioned before, that the VIX is not necessarily an indicator of a bottoming in the market or even a peak in the market. Back in the Great Recession on November 20th, when it peaked at above 80, that was 4 months before the market hit bottom. So it was March 9th, 2009 is when the market hit bottom, and volatility was, in terms of the VIX, was almost half of the level than it was back in November 20th. Or 2008. That's interesting. That's the case, and I think the reasons for that, and there's a couple slides that show kind of the difference in the ups and down days, which we'll talk about. There's a lot of things out there today, computerized trading and all that could be attributed to that. All right, so before we get into the next section, just a couple terms, that are key to understanding market volatility. So these are more related to drops in the market. So first, we hit a market dip. So that's when prices fall 5% from recent high. We call that a dip. A market correction. So if you ever hear us referring to a market correction, we're talking about a drop in prices 10% from the recent high. Once prices drop 20% from a recent high, that's when we enter a bear market, which we did do during this period. And even a market crash, when securities prices drop 30% from the prior highs, that signals a market crash. So, spoiler alert, we've hit all of these four in just the past 2 months, if you can believe that. So, actually 2 months to the day is when the S&P 500 hit the all-time high, and we're now come back from the lows, which we'll see in a second. But it's just the quickness of this drop has been unprecedented. So next, this in front of you is some facts about bear markets, and these next couple of slides, there's 10 of these points, which I just think they're very interesting. This slide goes against any type of PowerPoint presentation rules that you follow, because there's a lot of words. But this just, again, goes kind of through some of the facts of bear market, which I think are very interesting for people to understand. Again, number one, a bear market is a drop for 20% from the market peak. And this says, a new bull market begins when the closing price gains 20% from its low. So according to that, we're already out of the bear market because we've come up 20% from that low, which I'll show you in a second. On average, stocks lose 36% on average in a bear market. In contrast, they gain 112% during a bull market. So, bear markets are never fun, but you could see there a bull market, which we've had, one of the longest in the past 10 years. The bull markets are when the market has an upward trend for a long period of time, gain a lot more during the bulls than we lose during the bears. So that brings us to the next point. Bear markets are normal. So there have been 25 bear markets in the S&P 500 since 1928, and there's been 26 bull markets, and stocks have risen over the long run. So there's been about the same number of bear markets versus bull markets, but the point being that bull markets typically last longer than the bears. And there we go. Bear markets are short-lived. So the average length of a bear market is 299 days, or about 10 months. If we're in fact out of the bear market, that would have been a very short bear market, which is, kind of lends itself to the volatility that we've seen in the market. And then the frequency, but on average between bear markets, 3.6 years. So the longest market has gone without a bear market was from 1987 until 2000. So that was the longest period without a bear market, roaring 90s, as some of you know. And then bear markets have been less frequent since World War II. So, that's an interesting fact, that we're seeing more volatility these days, but bear markets are actually less frequent. I don't know what the reason for that is, but that has been a trend that we've been seeing. So, when we think about investing in our own investments, a lot of people obviously during a bear market, it's a very concerning time emotionally and financially for folks. So a lot of people, sometimes people have the urge to maybe sell out of the markets or reduce risk after the market has dropped. So this one's important that half of the S&P 500 index's strongest days in the last 20 years occurred during a bear market. So, and another 30% of the market's best days took place in the first 2 months of a bull market. So for folks that, have the urge to sit on the sidelines until this thing blows over, you could potentially miss out on some of the best days in the market. And once it turns around, most people, when someone says, I want to get out before, get back in once this blows over, you could miss those first very important days of the bull market when the market's roaring back. So that's why, again, stocks for long-term investors, and we're prepared to ride these things through. And then, bear market doesn't necessarily indicate a recession. So of the 25 bear markets since 1929, only 14 had recessions during that time. So bear markets often go in hand with a slowing economy, but it doesn't necessarily mean a recession. In today's environment, it's very likely that this will push us into a recession if we have negative GDP growth for the first quarter and the second quarter. Then, boom, we're in a recession. So if we have GDP again, which is the main benchmark for growth in the United States, if that goes negative for 2 consecutive quarters or a 6-month period, that's the definition of a recession. So it's very possible that this will push us into that. In the coming weeks, we'll get to see the GDP first initial estimate for the first quarter and see how that impact has been, and then depending on how long this economic impact is of the COVID-19, that could have us go into a recession for the first half of this year. So for someone who's long-term investor, in this case, if someone's just started and you've got a 50-year time horizon, you go through about 14 of these bear markets. So again, bear markets are a normal part of investing, and it's important to understand that when we're going through these, and you don't necessarily have to be comfortable with it, but being mindful that it is something that does happen. And kind of as one of the earlier points mentioned, bear markets can be painful, but overall they're positive for a large majority of the time. In fact, about 77% of the time, the market has gone up over the past 90 years of the markets. So that's even, when I saw these facts, I always said 70-30, the market goes up 70% of the time, goes down 30. That's even higher than I thought. So as long as we keep that long-term perspective, these bear markets will be a blip on the radar when we get to better times. So now we'll talk through where we are now in the markets in the current environment, and it kind of shows some metrics. As we mentioned, with the bear has emerged. So it's been 11 years of a bull market. So now we're, and once we hit that 20% drop we entered a bear market and stopped, had put the stamp on the end of that 11-year bull market, and the S&P 500 stock index. All the other indices, the Dow Jones and NASDAQ, entered a bear market around the same time. So, you can see here back, going all the way back 2009, during the financial crisis, Great Recession, you could see the drop in the market during those periods. And since then, we've had some volatility. There's been some, some fairly, big things happen in the markets in the world that has caused some downside in the stock market. The most recent being the tail end of 2018, in the fourth quarter, when, here it says 20%. We actually, the stock market did technically enter a bear market intraday, so it dropped below that 20% low during the day, but it closed above that. So we didn't technically go in from a closing value standpoint of the market. We didn't go into a bear market, but we were very, very close in that time period. Of course, that one roared back in the first few months of 2019, and that was, tariff concerns, recession concerns were coming up at that point in time, and now where we're at now with coronavirus and the OPEC, so we got the oil price war going on as well, which has also contributed to some of the drop. And as it shows there on the slide, if you can see those tiny numbers, 34% drop from the peak to the bottom, as we've seen so far. I don't call it the bottom, I'll call it the low of the market. So the significant drop, and a very quick significant drop as well. So you can see it just falls off a cliff. We did drop below the lows that we saw in 2018, when we had that sell off at the end of 2018. So you can see that kind of in the chart there. So fast, so very, very fast. So this chart here gives us a timeline of how long it took for the S&P 500 to drop 20%. And going back all the way to it looks like this goes back to 1957 or 1929 actually. In most cases it took a lot longer than it did in this time. So 16 days it took from the market, from that February 14th peak, or February 19th peak, sorry, to that 20% drop when we entered the bear market. It took 16 days, so very short time period for that to happen. The quickest on record. So this is one that's going to go down in the history books. Kids and students in finance school are going to learn about this one, just like how I was learning about the Great Recession when I was there. This is just unprecedented, and for one, this started as a health crisis, and kind of turned itself into a financial and economic crisis. So that, I think, is part of it. And there's just a lot, as I alluded to earlier, a lot of computerized trading, things like stop losses, where it sells you out of an investment immediately, which can kind of put a snowball effect on a sell-off, and make it faster. I think Rob and I were talking about this earlier today, and it's just been a snowball effect, and it's hard to believe that we're just 2 months from the last market high, and the market has dropped this quickly. So in scenarios where the market has dropped significantly in a quick period of time, kind of like it did at the tail end of 2018, it has historically shot back up quickly as well and recovered. We'll see if that's the case in this scenario. A lot of folks have been talking about a V-shaped recovery versus a U-shaped recovery. Do we bounce along the bottom for a little while, or once we start getting the economic data, is that going to be better than expected, and have the market bounce back faster. All right, so next, so where are we now? So this is a chart of the S&P 500 stock index. The market high here we hit on, as I mentioned, February 19th. So the first purple arrow there was when we hit that first market high. We hit a 5% dip there pretty quickly. Still in February, we hit a 10% in correction territory around the end of February. The market came back a little bit, and then boom, boom, boom. We just had sell-off after sell-off, and that's when we went into bear market territory very quickly on March 12th or so. Or that week. So, and then we had a big rally day. So yes, I think that was the 12th. The market rallied the following day on the 13th, and then it sold off significantly on the 16th of March, and then we even dropped further from there, and that's when we hit crash territory later in March, and then bottomed out on the 23rd, or hit that low on the 23rd of March. So from February 19th, when we hit the market high, all the way down to the current low, which was the March 23rd, that was a 34% drop from the top of the market, or the market high. As you can see here, we've had a bit of a rebound. This is about midday yesterday when I ran these numbers, and we're already from the low, the current level here, the S&P at 2745. We're about 23% above the low. We still have another about 23% to go to get back to the market high, and I think just the impact this has had on company earnings, it could be some time before we get there. And I don't think we're through this yet, and I think we're surely going to see some more volatility, likely to the downside too. As we continue to get data, and we see hopefully see the virus peak in the United States, and start to go back the other direction. But one thing which leads me to the next slide here is that the further or deeper that the market drops, the more we have to earn for it to bounce back on the upside. So in this case, with the market dropping 34% from the top to the bottom, you can see, if the market drops 35%, we have to get back 54% just to get back to even. So if the market drops 50%, we have to get 100% to get back. So the deeper the drawdown, the higher we have to go to get back to the previous high. So I don't know if necessarily that means that it takes longer to get there, but it is, we have to earn back in percentage terms more to get back to that high water mark. And this, middle one, with the market being down 34% at the bottom, we have to earn about 50% or so to get back. So that's pretty significant, upside if the market, once we get back to that all-time high, which we will eventually. We just don't know how long that'll be. And then, looking at volatility in history, this is a busy chart, but I think that the interesting thing to point out on this chart, the thing I found most fascinating about it is what this does, by the way. So this goes back this chart goes back to 2007. It has an average going back to 1950, and what it does is shows the number of days plus or minus 2% in the S&P 500 stock index. So it's got 2% negative moves, 2% positive moves, and it tallies those up on a year-by-year basis. It gives us an average since 1950, and then it also gives us an average from 2000 to 2019. And the interesting thing, with those two averages, so the total of plus or minus 2% moves in the S&P 500 since 1950, there was 11. So there's 11 cases where the average was 11, 2% plus or minus moves in the S&P 500 index. If we look at a more shorter term average from starting in the 2000s, that number almost doubles. So volatility has been a lot higher, in that shorter time period. And, I think a lot of that could be attributed to 2008, 2009. So 2008, there were 72 days of plus or minus 2% moves in the S&P 500 index. So a lot more volatility than we've seen historically. So far this year, we are at 21. So even, as far as volatility is concerned, now keep in mind that we've also had some of the historically largest swings. So we have, almost over 10% days in the market. So this is just 2% moves. So where, in this case, we may have had some more dramatic up and down movements. We've had less from just a pure 2% daily up and down move. So that's what was interesting to me about this, those averages and if we annualize it, 2020, it brings that way up. So you can see, more recently how much volatility has increased in today's markets. Again, I think it can be attributed to just the accessibility. You no longer have to call your stockbroker and place a trade, or call in trades. A skyscraper in New York, I could walk around with my phone and place trades throughout the day. So it's just way more accessible for folks to go in and make trades, and as well as a lot of the computerized trading, as I mentioned, and some of those other features that you could tie to certain investments to sell out at certain times. So for folks that might get nervous and want to get out of the market, this slide here just is very interesting in showing that for someone who stays fully invested, again, this is if you had 100% invested in stocks, what your earnings would be, or your annualized return in the S&P 500 index for a 15-year time period, so going back to 2004. If you miss just the best 10 days, so if you're out of the market for the best 10 days of that 15-year period, it cuts your return in more than half. So and again, going back to the earlier point, that a lot of times the best days are during a bear market or during a volatile period. So missing out on those 10 best days can have a dramatic effect on your end result. And it just gets worse from there. After you miss the best 30 days, you've got a negative return. So that's where it's important to stay invested. It's just very hard to time these movements in the market. In most cases, the best thing you could do is just be prepared to ride it through. And that's what we've done. And, this one, I won't spend a lot of time on this one, but this talks about how, retail investors typically get out at the wrong time and get in at the wrong times. So the blue bar chart there shows money flows, so dollars going into stock mutual funds. So during 2008, 2009, when the market was dropping considerably, people were selling out of the market, which is, again, not the thing to do. On the other end, as in the last, or at least the last 5-6 years, as the market has continued to go upward, people have been selling out of stock and mutual funds quite a bit, interestingly enough, and even in that has peaked with this current drop. When we talk about that, that's a whole other presentation on behavioral finance and the emotional aspect of investing. You can see it here in the data that folks that try to make these calls themselves typically do it at the wrong time. So, putting together a more systematic approach of investing in a long-term plan versus one that, reacts day to day is very important. This one shows this chart here shows the number of days it took to bounce back, and this is kind of going with the same theme of some of the market's best days are following some of the worst days. So this shows some of the drops in history. It's got 2020 there, so it's got the current drop in there, and that's those 2 days I talked about. So the big down day on the 12th of March, and then the big recovery just 1 day after. Goes back to 2011. So most of these, the longest, if you look at 2008, it took 10 days to get that big move on the upside, but it's a very short period of time, and that's where volatility comes into play, because if the market's being volatile on the downside, there's going to be some volatility on the upside as well, and those are those days we don't want to miss out on. So again, important to stay invested. Going back to all a lot of other market crises, that going back to to Black Monday in the 80s. This shows these sell-offs and the next 12 months of stock market performance. So that trade war that I talked about earlier, the trade war, tariff debacle, the fourth quarter of 2018, market dropped almost 20%, and the following 12 months it was up 37%. Again, just looking at the S&P 500 stock index, but periods of big sell-offs are typically followed by positive markets. So the financial crisis, stock market from peak to trough, and the Great Recession dropped about 56%. The next 12 months, it was up 68%. That didn't get us back to even, because you remember, if we drop 50%, we got to earn 100% to get back to even. But those are certainly returns that you don't want to miss out on. And, trying to time that is just very difficult, if not impossible to do. So in the final section here, and I don't want to keep it too long this morning, but final section here is, how does all this information apply to you and your own investments, your own portfolio, and your own financial plan? So, one thing that, if you're a client of Pathfinder, you've been through a risk assessment. So, one of the first things that we do is a risk assessment to determine what risk profile you fall into. And we have 5 different risk classes generally that we use. And that's just important to get a gauge on, are you a more risk averse person, or are you okay with taking risk? And generally in investing context, we loosely apply, the higher risk someone's willing to take, the more stocks that we'll have in a portfolio. Again, as I mentioned before, all stocks are not created equal, so we still want to have a strategy and a diversified group of investments. And then second, not just understanding what type of investor you are, but understanding the risk in your investments. And this is an important one, both the upside and the downside. So, again, for clients of Pathfinder, we're taking you through a financial planning process and testing these scenarios. Anyone who's gone through our planning process, we've tested a scenario like 2008, 2009 as a worst case scenario to make sure that your portfolio and your financial plan can hold up to these periods of volatility, which we know are temporary. So that gives folks a lot of peace of mind going into a bear market like this, that we've tested this, we know that we can get through this. And then, and lastly, gearing your investment strategy to your risk profile and time horizon. So time horizon is important. If someone, comes out with risk assessment, most aggressive person, we've seen really high on the risk spectrum, if they're in retirement and they're living off their money now, we're not going to recommend that you be 100% in stocks, because you need some stability in there to cover your living expenses. on the conversely, someone who's just getting started, an accumulator is just starting to invest. If they come out very risk averse on the risk assessment, we might tailor back the risk a little bit. But with someone with a long time horizon like that, they're really missing out on a lot of potential benefit by having a lower percentage in stocks. Stocks are our growth vehicles. They're also the most volatile of the investments, the investment spectrum, but they're important for most folks to be able to keep up with inflation. Otherwise, if someone is very conservative and does not want to have anything to do with the stock market, that's okay. You just have to be a really good saver, because you got to save more to be able to make up for the missed potential of investment returns. So talking about the risk profiles again, so these are the general categories of 5 different risk profiles that we have. So we've got a new risk profiling system that we're using this year called Riskalyze that will determine a risk number for you and your portfolio, and we make sure that those two align. So if you haven't gone through that yet, you will be. And these profiles, again, loosely, you put a certain amount of stock to a maximum of a certain level in each of these categories. So a conservative investor, we're going to limit that at about 20% in stock, whereas aggressive investor, we have up to 100% stock in there. Moderate, right down the middle of the road, you've heard that called a balanced portfolio. That's, a lot of retirees are in that style of portfolio. We have 60% in stock, but then 40% in bonds to add that stability and income. But then also for folks taking money out, a cash reserve strategy. So a systematic process of getting your income and making sure your income is safe. And these are the scenarios that we test during the financial planning process to make sure that that your financial planning can hold up to any volatility in the markets. So the key to all this and getting through market volatility is obviously trying not to panic. If it takes not looking at your statement for a few months, maybe that's the best thing to do. But these are historically, as we talked about earlier, bear markets are short-term in nature compared to the potential growth of the market over the long run. So it's important to do the planning up front and understand your downside. So then when we get in a scenario like this, you don't have the urge to panic and sell out of the market which would mean that you're essentially locking in gains that you won't get back when the market rebounds. Same point there, sticking with the strategy, understanding your strategy is an important one too. So then that way you know what the potential is if when we go through some of these periods in the market. Resist the urge to time the market as much as that is appealing it is to try to get out and hold out for a little bit until the market drops further. That's very difficult to do. We always say you've got a 50-50 chance of getting out at the right time. You got a 50% chance of getting back in at the right time. So that's a 25% probability of getting it right. It's very difficult to do. If people tell you they've effectively done that, they're either lying or they can't do it consistently. And then staying diversified is important. So especially in an environment like right now, where there are a lot of opportunities out there in the market. I've had all of us have had countless questions about investing in stocks and trying to pick a stock or two that's going to bounce back quickly. It's very tempting to do that because some of these companies have, especially certain sectors of the market, have gotten beaten up. Airlines and travel companies and energy companies. It trickles to a lot of different areas, but it is important to be diversified. It's where that could work out. There's also a very high risk of doing it if that company doesn't come back as fast as others, or there's some type of company-specific risk that causes that stock price to be depressed for a longer period of time. So, so in a lot of cases, we'd recommend putting in something more diversified, like a mutual fund or index fund or ETF, or at least buy a basket of individual stocks instead of just a few. Having a plan, we talked about that, having a plan, testing the scenarios, making sure that your plan can hold up to a scenario like this. With any challenge, any market, downturn like this, there are opportunities. So, of course, a buying opportunity for long-term investors. Prices are still low. We're still, as I mentioned, about 23% down from the high. So still a fantastic buying opportunity for investors, for people that have cash that they don't need in the short term. A good time to invest for, folks that are accumulating. If you've been thinking about bumping up your contribution rate to your 401k or your IRA, now would be a time to do it. Things that we're talking about on the back end here, rebalancing. So going through and rebalancing accounts, and what that's doing, naturally right now, the stocks being down, we have a rebalancing system where it's going to get us back to our parameters in the portfolio. So selling from bonds that have held up better, more relative to the stocks, and putting it into stocks to take advantage of this opportunity. Roth conversions are one that we've, that's come up in the media, and the ones that we've talked about with folks. Not appropriate for everyone, but with values being low, converting traditional IRA money, so pre-tax money, to Roth after-tax money, this is a good time to do it when the market's down, because you get money over in a lower, money over at a lower amount, a lower taxable amount, and then it's in after-tax Roth status, tax-free forever. So that's something that always comes up at a time like now. Tax loss harvesting is another thing that we're actively doing in client accounts, and that's where we sell a position that has a loss and immediately buy an equivalent position. So for an easy example, if we were invested in the S&P 500 stock index fund, we could sell out of that S&P 500 stock index, buy another one. So go from maybe the Fidelity index fund to the Vanguard index fund, and we're still invested, but we're taking that loss on paper, and then you could use those tax losses until you use them up. So you can carry those forward, either taking up to $3,000 off your income for the tax year, or you could use it to offset future capital gains. So those are some opportunities that we see as part of this. And then individually for accumulators versus retirees, as I mentioned earlier, with accumulators, folks that have a long-term time horizon, now would be a good time to invest or increase retirement contributions, Roth conversions, and more importantly, focus on the end goal and not the day-to-day, because that's what's most important. And then retirees, those that are living off their savings, we do this, if you're a client of ours, we have a disciplined rebalancing and cash reserve strategy that I mentioned earlier. So, cash reserve strategy is where we rebalance systematically to set some cash aside for your required distributions, which you now don't have to take for 2020, or for any income that you need throughout the year. So that you're trying to keep that income safe for market movements as part of this. And what I always tell folks when they get nervous about investments, go and enjoy retirement. Do it. That's why we do the financial planning up front. So when we go through periods like this, you can go and do. Now, obviously, right now you're kind of stuck indoors, and traveling isn't an option. But maybe once once you might go get some discounted flights later on in the year, or book that trip for 2021. So focus on what you originally wanted to do, what you told us that you wanted to do in retirement. That's what's important. We're here to handle the investment end of it, and make sure that we're consistently getting your income, and doing these things on the back end, like rebalancing to take advantage of these opportunities, or to fill up those cash reserves. All right, so that's all I've got for today. And of course, we're always here if you ever have any questions and concerns. Some of us are coming to the office, some of us are working remotely, but we're here, and we've got all the capabilities to do anything that we could have done in the office working remotely. So I appreciate everyone jumping on the call, and we will talk to you soon.